Today we are breaking down a powerful statement from Tom Lee, Head of Research and Chief Investment Officer at Fundstrat Capital. In his latest appearance on Closing Bell, he said something that caught a lot of attention. He believes this is the makings of a bottom in the stock market. He explains what investors should be watching right now and what he still needs to see before confidently calling an equity bottom. In this video, I am going to show you the clip from CNBC. After that, I will give you my full reaction and breakdown of what Tom Lee said and what it really means for investors. Then we are going deeper into 3 growth stocks that I believe you can buy and potentially retire on over the next 10 years. Make sure you hit the like button, share this video, and drop your thoughts in the comments. Subscribe to the channel so you do not miss the next important investing update. Now let's hear what Tom Lee has to say.
Tom Lee, now he's here with us at Post 9. It's good to have you back. Your thoughts as you look at these markets. Been real interesting price action over the last couple of days. Thought our reporters set the table very well on the issues at hand that investors need to keep their eyes on. What about yours?
Yeah, I think the headlines have been scary. No one wants to see the U.S. in a conflict, but I think it's been spot on to note that markets have been taking this much better than expected. I don't think anyone can say we're bottomed yet, but this is what looks like the makings of a bottom, right? That you get bad news and the markets are taking it in stride. And more importantly, I think we've had a position reset. And so on the other side of this, I think is going to be a lot of opportunity.
What would give you the confidence to say, you know what, that's a sign of a bottom? What do you need to see?
Well, some things like if we go back to April, a simple thing would be the VIX making a spike to over 40. Last year was 80, but we won't get to 80. And then, of course, retracing. That would be a clean sign because that's so much de-risking. Another sign would be we get another scary headline and gold continues to sell off, and then stocks actually turn green on the day because that means we've washed things out. I think we're pretty close.
You're watching oil as closely as everybody else is. I thought it was interesting, some of the notes today. UBS says we expect only minimal or a brief disruption to global energy supplies. We therefore stick with our base case that U.S. equities, will produce good gains this year. Katie Huberty over at Morgan Stanley. Recent geopolitical events unlikely to change our bullish view on equities over the next 6 to 12 months. What do you think?
Yeah, I mean, I think oil. I think we saw things that kind of made sense to me. Oil spiking on closures or potential closures of the Strait of Hormuz, but the response from Washington, and I think that's maybe more important. That I don't think Washington wants high oil prices into the midterms, and of course it's very unpopular with Americans. I mean, it's a big burden. So I'm going to be in the camp that I'm watching the price action. I think it's encouraging that oil's not surging into the close.
Hey, part of the Huberty note focuses on the AI trade, which has been really interesting, I thought, over the last couple of days. Back, some might say, to that safe haven type price action. I mean, look at right now. Microsoft's up, Meta's up, Amazon's up, Nvidia's traded better over the last couple of days. What do you make of that?
Well, in our view, March was the makings of a bottom because the software, the Mag 7, and the cryptos we thought were like 90% through to their winters or declines. They are outperforming, and I think that's a sign of leadership. But fundamentally, you're absolutely right. If we get global trade disruption, you still need AI, and you still need the Mag 7. So I think they're actually good fundamental stories.
Right from the start, the conversation centers on fear, the future, liquidity, geopolitical tension, scary headlines. That is the emotional backdrop. Investors are asking themselves a very simple question. If things get worse, will I be able to get my money when I need it? That fear around liquidity is powerful because it is not just about stock prices. It is about stability in the financial system. And what Tom Lee is essentially saying is that despite the noise, markets are absorbing this shock better than expected. Now that is important. When you have bad news and markets do not collapse, that tells you something. He makes it clear that we are not officially at a bottom yet, but he says this is what the makings of a bottom look like. That phrase matters. A bottom does not usually feel calm and obvious. It feels uncomfortable. It feels uncertain. It feels like you are buying when headlines are screaming at you not to. What stands out to me personally is his emphasis on position reset. That is Wall Street language for de-risked positioning. It means investors have already sold a lot. They have already hedged. They have already pulled back. When positioning is light, it reduces the risk of forced selling. In my opinion, that is one of the most underrated factors in market bottoms. It is not just about valuation, it is about who is left to sell. Then he talks about what would give him confidence that we are actually at a bottom. He brings up the VIX, specifically, a spike above 40. Now historically, that kind of volatility spike signals panic. Last year we saw readings near 80 during extreme stress, but he does not think we need that level this time. What he is looking for is a cleansing event, a volatility surge followed by a quick retracement. That pattern often marks capitulation. Here is where I agree with him strongly. Markets often bottom not when news improves, but when reactions to bad news become muted. He mentions another sign. A scary headline hits, gold sells off, and stocks actually turn green on the day. That would indicate exhaustion of fear. That is when sellers are out of ammunition. Personally, I think that is a critical observation. We tend to focus on news, but price action tells the real story. If markets stop falling on bad news, it means expectations have already been priced in, and that is how bottoms form. The oil discussion is also very telling. Oil spiked on fears about disruptions in the Strait of Hormuz. That makes sense mechanically. If supply risk rises, oil prices rise. But Tom Lee shifts the focus to Washington's response. He points out that high oil prices are politically unpopular, especially heading into midterm elections. That is not just a political observation, it is a market signal. Policymakers are aware of the economic burden of high energy costs. What I found interesting is his comment about oil not surging into the close. That intraday behavior matters. If oil spikes early and fades, that suggests the market does not believe in a sustained supply shock, and that is bullish for equities. Energy price stability reduces inflation risk, which reduces pressure on interest rates. In my view, oil is the pressure valve here. If oil were to surge aggressively and hold those gains, that would change the narrative, but so far the market is treating it as a temporary geopolitical premium rather than a structural shift. Then the conversation shifts to the AI trade and the so-called safe haven behavior of mega-cap technology stocks. We are seeing Microsoft up, Meta up, Amazon up, Nvidia trading better. That is not random. Leadership matters. In market recoveries, strong leaders often turn first. Tom Lee says something that I think is crucial. He believes March was the makings of a bottom for software, the Magnificent Seven, and crypto. He estimates they were about 90% through their decline. That is a bold call, but the reasoning is rooted in relative strength. When prior leaders start outperforming again, that is often a sign that institutional capital is rotating back into growth. Here is my take. AI is not just a theme. It is an infrastructure shift. When uncertainty rises, investors still want exposure to long-term structural growth. That is why these names can act like safe havens, even though they are technically growth stocks. Their earnings power and balance sheets provide a cushion. What I also appreciate is that he is not blindly bullish. He acknowledges we are not confirmed at a bottom yet. He is watching signals. VIX behavior, gold reactions, oil price action, leadership from AI names. This is process-driven analysis, not emotional reaction. Another subtle point in this interview is liquidity. The opening question referenced future liquidity. When markets get nervous about liquidity, that can spiral quickly. But the fact that markets are functioning, volatility is elevated but not disorderly, and leadership stocks are stabilizing suggests liquidity stress is not systemic at this point. In my opinion, that is a major difference between a correction and a crisis. In a crisis, liquidity disappears. In a correction, sentiment collapses but plumbing remains intact. What Tom Lee is implying is that this feels more like a correction within a broader bull trend rather than the start of something structurally broken. Now let me push back slightly. While I agree that price action has been resilient, geopolitical conflicts can evolve unpredictably. Markets are forward-looking, but they are not omniscient. If escalation were to significantly impact energy supply or global trade routes, we would likely see a reassessment. So while I appreciate the constructive tone, I think risk management still matters heavily here. What I take away from this interview overall is that Tom Lee sees opportunity forming out of fear. He believes positioning has been washed out. He believes volatility spikes could finalize the bottoming process. He sees leadership returning in AI and megacap tech, and he is not seeing confirmation from oil markets that this conflict will spiral into sustained economic damage. The key message for investors is this: watch the market's reaction to bad news, not just the bad news itself. If stocks absorb shocks, if volatility spikes and fades, if leadership strengthens, those are early signs that the worst may already be priced in. For me personally, I think this is a time to be selective, not reckless. If you believe in long-term structural themes like AI and digital infrastructure, pullbacks can be opportunities, but I would still scale in rather than go all in at once. This interview is less about predicting headlines and more about reading market behavior, and that is the skill that separates reactive investors from strategic ones. Now let's dive in and talk about the 3 growth stocks to buy and retire in 10 years. Let us begin with MongoDB, ticker symbol MDB. MongoDB operates in one of the most mission-critical layers of the technology stack: data. Every application you use today, whether it is a mobile app, an enterprise platform, or an artificial intelligence system, runs on databases. Traditionally, many enterprises relied on relational databases that require rigid schemas and structured formats. But the world has changed. Modern applications generate unstructured and semi-structured data at massive scale. Think user activity streams, sensor data, AI training sets, and global e-commerce transactions. MongoDB's document-oriented architecture was built specifically for this new reality. It allows developers to store data in a more flexible format, enabling faster iteration and easier scaling. Why does this matter for a 10-year retirement thesis? Because data growth is not cyclical, it is exponential. As more devices connect to the internet, as artificial intelligence models expand, and as enterprises digitize every process, the demand for flexible, scalable databases will only increase. MongoDB is not just riding a trend, it is embedded in it. A key driver of MongoDB's growth is Atlas, its fully managed cloud database platform. Atlas allows customers to deploy databases across major cloud environments without managing infrastructure themselves. This is critical. Enterprises want simplicity, scalability, and reliability. Atlas delivers that through a subscription model that generates recurring revenue. Recurring revenue changes the entire risk profile of a growth company. Instead of relying on one-time license sales, MongoDB builds long-term relationships with customers who depend on its platform for daily operations. Once a company builds applications on MongoDB, switching becomes extremely complex. Data migration, re-engineering code, retraining teams, all of that creates significant switching costs. From a financial perspective, MongoDB has consistently delivered strong revenue growth driven by Atlas expansion and enterprise adoption. Analysts have highlighted continued momentum in cloud revenue, which now represents the majority of total sales. This shift toward cloud subscription revenue enhances predictability and long-term visibility. Margins are also improving as scale increases. That is what you want to see in a high-growth software company. Early stages focus on market share and product expansion. Over time, operating leverage begins to show up. Expenses grow slower than revenue, and profitability expands. Another important factor is developer ecosystem strength. MongoDB has cultivated a large global developer community. Developers often choose tools based on ease of use, flexibility, and documentation. When a database becomes a developer favorite, that preference tends to spread across organizations. Over a decade, this type of grassroots adoption can create a powerful competitive moat. Artificial intelligence also represents a significant opportunity. AI applications require massive volumes of diverse data. MongoDB's flexible architecture makes it well-suited for AI-related workloads. As enterprises integrate AI into customer service, analytics, and automation, database demand could accelerate further. Now let me give you my personal take. MongoDB is a classic example of a company that may experience volatility in the short term, but has a clear structural growth path over the long term. Enterprise spending cycles can fluctuate. Macro slowdowns can temporarily impact new project launches. But if you look 10 years ahead, it is hard to imagine a world where data storage and cloud databases are less important than today. For retirement-oriented investing, the key question is not whether revenue grows next quarter. It is whether the company's role in the digital ecosystem becomes more entrenched over time. In my view, MongoDB's positioning in modern application development gives it a strong chance to do exactly that. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let us transition to the second company, Atlassian, ticker symbol TEAM. Atlassian operates in the collaboration and productivity software space, but describing it that way does not fully capture its importance. Atlassian builds tools that sit at the heart of how modern teams plan, build, track, and execute projects. In a digital economy where companies are globally distributed and increasingly reliant on software, coordination is everything. Atlassian's core strength lies in its land and expand strategy. It often enters organizations at the team level with affordable entry points. Developers, product managers, and project teams adopt its tools because they solve immediate workflow problems. Over time, usage expands across departments and eventually across entire enterprises. This expansion model creates durable growth. Instead of relying solely on top-down enterprise contracts, Atlassian grows organically within organizations. That bottom-up adoption is powerful because it reflects genuine user preference. The shift toward cloud subscriptions has further strengthened the business model. Atlassian has been moving customers from on-premise installations to cloud-based subscriptions. Cloud revenue provides predictable recurring income and allows the company to roll out new features seamlessly. Analysts have emphasized the long-term benefits of this cloud transition. As more customers migrate, revenue visibility improves and margins have the potential to expand due to scale efficiencies. But beyond financial metrics, what truly makes Atlassian compelling over 10 years is the digitization of work itself. Remote and hybrid models are not temporary anomalies. They are structural changes in how organizations operate. Global teams require transparent workflows, real-time collaboration, and centralized task management. Atlassian's ecosystem supports all of this. Its products integrate deeply into development pipelines, customer service workflows, and project management systems. Once embedded, replacing them becomes disruptive and costly. From my perspective, Atlassian represents a bet on organizational complexity increasing over time. As companies grow, launch more products, and operate across borders, coordination challenges intensify. Software that simplifies that complexity becomes indispensable. Competition exists, of course. The collaboration space is crowded. But Atlassian's developer-focused approach and strong brand within technical communities provide differentiation. Over a decade, brand trust and ecosystem integration can compound into a meaningful moat. If MongoDB powers the data layer, Atlassian powers the workflow layer. Both sit beneath the surface of everyday digital experiences, quietly enabling productivity at scale. When you think about long-term retirement investing, you want businesses that become more embedded over time, not less. Atlassian's tools are not surface-level applications. They are deeply integrated into how teams operate every single day. Project planning, sprint tracking, bug reporting, service management, internal documentation. These processes are mission-critical. When software becomes the operational backbone of thousands of teams, that creates durability. One of the most important shifts in Atlassian's business has been its aggressive transition to cloud subscriptions. Moving customers from self-managed data center deployments to cloud-based infrastructure does several things. First, it improves recurring revenue visibility. Second, it increases customer lifetime value. Third, it enables Atlassian to push updates, new features, and integrations seamlessly across its user base. Analysts have pointed out that cloud growth remains a key driver for Atlassian. Even during periods when enterprise budgets tighten, collaboration software often remains prioritized because productivity cannot be compromised. In many cases, companies actually consolidate tools during downturns, favoring comprehensive platforms that reduce fragmentation. That dynamic can work in Atlassian's favor. Financially, Atlassian has demonstrated strong revenue expansion over the past several years. While margins have fluctuated as the company invests in cloud infrastructure and product innovation, the long-term thesis centers on operating leverage. As more customers adopt higher-tier plans and additional modules, incremental revenue carries higher margins. Another powerful element of Atlassian's strategy is its ecosystem approach. The company has built a marketplace where third-party developers can create integrations and extensions. This expands functionality without Atlassian having to build every feature internally. Ecosystems strengthen moats. The more integrations and workflows built around a platform, the harder it becomes to leave. Over 10 years, this matters enormously. Retirement wealth is built through compounding. Compounding happens when revenue grows consistently, margins expand gradually, and capital is reinvested intelligently. Atlassian has the structural characteristics that can support that cycle. Now here is my personal perspective. I view Atlassian as a productivity infrastructure play. Just as utilities provide electricity, collaboration software provides organizational clarity. As artificial intelligence tools become embedded into workflows, Atlassian is positioned to integrate AI-powered automation into task management, ticket resolution, and project forecasting. That could enhance efficiency for customers and increase monetization opportunities. Of course, no investment is risk-free. Enterprise software spending can slow during economic downturns. Competitive pressures can intensify. But when I evaluate long-term durability, I focus on user reliance. If a company's tools are opened every single day by millions of users, that is a strong signal of embedded value. Now let us transition to the third company, 𝗗𝗟𝗏𝗏, ticker symbol AVAV. 𝗗𝗟𝗏𝗏 operates in a completely different arena, but one that is equally significant over the next decade. It specializes in unmanned aircraft systems and advanced defense technologies. As global security landscapes evolve, autonomous systems are playing an increasingly central role in surveillance, reconnaissance, and tactical operations. Why is this important from a retirement investing perspective? Because defense modernization is not a short-term trend. Governments around the world are investing heavily in technology-driven capabilities. Unmanned systems reduce risk to personnel, increase operational flexibility, and provide data collection advantages that traditional platforms cannot match. 𝗗𝗟𝗏𝗏 has built a reputation for delivering reliable, mission-critical drone systems used by defense agencies. These systems are not consumer gadgets. They are specialized tools designed for real-world operational environments. That specialization creates barriers to entry. Analysts have highlighted strong order backlogs for 𝗗𝗟𝗏𝗏. Backlog matters because it represents contracted future revenue. When a company has a robust pipeline of orders, it provides visibility and stability. For long-term investors, visibility reduces uncertainty. Financially, 𝗗𝗟𝗏𝗏 has experienced revenue growth driven by increased procurement and expanded demand for autonomous systems. As defense budgets adapt to geopolitical realities, companies that provide cutting-edge capabilities often see sustained funding. Another aspect to consider is technological advancement. Autonomous systems are evolving rapidly. Improvements in battery life, sensor technology, data transmission, and artificial intelligence are expanding the capabilities of unmanned platforms. 𝗗𝗟𝗏𝗏 operates at the intersection of hardware and software innovation, positioning it to benefit from this evolution. From my personal standpoint, investing in defense technology requires acknowledging uncomfortable realities. Global tensions and security challenges are unlikely to disappear in the coming decade. While we all hope for stability, history suggests that governments will continue prioritizing technological superiority. Companies providing advanced unmanned systems may therefore experience consistent demand. There are risks. Defense spending can be influenced by political shifts and budget negotiations. Contract timing can create quarterly volatility, but over a 10-year horizon, structural demand for advanced defense systems appears resilient. When you compare these three companies side by side, you see diversification across sectors and themes. MongoDB powers the data infrastructure layer of modern digital systems. Atlassian enables organizational execution and collaboration. 𝗗𝗟𝗏𝗏 advances autonomous defense capabilities. Each addresses a different pillar of long-term global transformation: data growth, workplace digitization, defense modernization. Now let us think about how these businesses could work together in a retirement-focused growth portfolio. MongoDB offers exposure to cloud adoption and AI-driven data expansion. Atlassian provides participation in the productivity software ecosystem that supports global enterprises. 𝗗𝗟𝗏𝗏 gives exposure to government-backed technological innovation. Diversification across these themes reduces reliance on any single macro factor. If enterprise software spending slows temporarily, defense contracts may remain steady. If defense budgets fluctuate, cloud data growth may continue uninterrupted. Over 10 years, this balance can smooth volatility while preserving upside potential. Another key consideration is competitive positioning. MongoDB benefits from developer adoption and switching costs. Atlassian benefits from workflow integration and ecosystem strength. 𝗗𝗟𝗏𝗏 benefits from specialized expertise and government relationships. These are distinct moats, each reinforcing long-term durability. From a valuation standpoint, growth stocks can experience cycles of enthusiasm and skepticism. There will be periods when multiples expand aggressively and periods when they compress. Retirement investing requires emotional discipline. The objective is not to trade every fluctuation but to own businesses that continue increasing intrinsic value. Personally, I believe the most powerful wealth-building strategy is identifying companies that become more relevant over time. All three of these businesses have credible paths to increasing relevance. Data will not become less important. Collaboration will not become simpler. Autonomous defense systems will not become obsolete. Now let us take everything we have discussed and push it forward into the next decade. Because when you say buy and retire in 10 years, that is a bold statement. That is not short-term trading. That is not chasing hype. That is committing capital to businesses you believe can meaningfully expand their intrinsic value over a full market cycle. So let us walk through what that could realistically look like. First, we need to talk about compounding in practical terms. If a company grows revenue at 20% annually for 10 years, it more than sextuples its top line. If it grows at 25% annually, revenue increases by more than 9 times over a decade. Now imagine that revenue growth is paired with expanding operating margins and disciplined reinvestment. That is how long-term shareholder wealth is created. The key question is not whether these stocks can bounce next quarter. The key question is whether they can structurally grow through multiple economic environments. Let us revisit MongoDB with that lens. If MongoDB continues benefiting from the explosion of data creation, AI workloads, and cloud migration, it could maintain strong revenue growth over the next several years. The company's Atlas platform is central to its future. Cloud-native, consumption-based, scalable. As more applications are built using MongoDB as the default database layer, switching costs increase. In 10 years, the total addressable market for database solutions will likely be significantly larger than it is today. If MongoDB maintains competitive positioning and continues innovating, its share of that expanding market could translate into massive revenue scale. Now layer in operating leverage. As software companies scale, their cost structures often improve. Research and development as a percentage of revenue can decline. Sales and marketing efficiency improves as brand awareness grows. Infrastructure costs become optimized. If MongoDB transitions from high growth mode to mature scale mode over the next decade, margins could expand meaningfully. That combination of revenue growth and margin expansion is powerful. But here is the discipline part. There will be volatility. Growth stocks are sensitive to interest rates, economic cycles, and investor sentiment. In a 10-year holding period, you should expect multiple corrections of 20% or more. That is normal. The question is whether the underlying business keeps progressing despite market noise. Now let us revisit Atlassian with the same framework. Over the next decade, enterprise collaboration will become more integrated with automation and artificial intelligence. Workflows will become smarter. Task assignments, sprint forecasting, customer ticket routing, documentation tagging. AI will not replace collaboration tools. It will enhance them. If Atlassian successfully integrates AI capabilities into Jira, Confluence, and its broader ecosystem, it could increase average revenue per user while improving stickiness. Imagine teams relying on predictive analytics inside their project management dashboards. That deepens dependency. Additionally, as global workforces remain distributed, the need for digital coordination platforms remains critical. Remote and hybrid work models are not temporary experiments. They are structural shifts. From a financial standpoint, if Atlassian continues migrating customers to cloud subscriptions and increasing monetization across its installed base, recurring revenue stability strengthens. Over 10 years, that predictability compounds. And do not underestimate cultural embedding. When a company's tools are baked into internal training, onboarding, and corporate processes, removing them is disruptive. That inertia can protect revenue streams even during economic slowdowns. Now let us revisit AeroVironment. Defense technology is different from enterprise software. It is contract-driven. It is influenced by geopolitical realities. It is tied to national security priorities. But here is what matters. Autonomous systems are not a passing phase. Military strategy is increasingly data-driven, sensor-driven, and unmanned. Drones and autonomous platforms reduce risk to personnel and provide tactical advantages. If global tensions remain elevated or even moderately persistent, defense budgets focused on modernization may remain robust. AeroVironment's expertise in unmanned systems positions it within that modernization wave. Over 10 years, technological advancement could significantly expand the capabilities of its systems. Longer endurance, better sensors, AI-assisted navigation, swarm coordination. If the company continues winning contracts and innovating effectively, revenue growth could remain durable. However, this stock may experience greater quarterly volatility due to contract timing and budget approvals. That is why position sizing matters. Now let us talk about portfolio construction. When you say you want to retire in 10 years, concentration risk must be managed. Even high-conviction ideas should not dominate your entire portfolio. A balanced allocation across these three growth names, combined with broader market exposure and defensive assets, can create resilience. For example, an investor might allocate a defined percentage of their growth bucket to MongoDB, Atlassian, and 𝗗𝗟𝗏, while maintaining index exposure and possibly dividend-paying assets elsewhere. That approach allows participation in upside without risking catastrophic downside from a single company underperforming. Risk management is not about fear, it is about durability. Next, let us discuss valuation discipline. Growth stocks often trade at elevated multiples when sentiment is optimistic. The best long-term outcomes frequently occur when you initiate or add positions during periods of skepticism. Market corrections, macro scares, and earnings volatility can create entry opportunities. This is where 𝗗𝗏𝗧 comment about the makings of a bottom becomes psychologically important. If markets are stabilizing after a drawdown, investors willing to look beyond fear may capture attractive long-term entry points. But even if the exact bottom is not perfectly timed, a decade-long horizon reduces the importance of short-term precision. What matters more is owning businesses that increase intrinsic value year after year. Now let us imagine a realistic scenario. Suppose MongoDB compounds at 20 to 25% annually for 10 years. Suppose Atlassian compounds at a similar range as enterprise digitization continues. Suppose 𝗗𝗟𝗏𝗏 compounds slightly more unevenly, but benefits from sustained modernization demand. If even two of the three deliver strong double-digit annualized returns, the cumulative impact over 10 years could be transformative. That is the power of exponential growth. A 10% annual return doubles capital roughly every 7 years. A 15% annual return doubles capital in under 5 years. A 20% annual return can multiply capital more than 6 times over a decade. These are not guarantees. They are mathematical illustrations of what sustained compounding can do. Now let us be realistic about risks. Technology shifts can disrupt leaders, competitive pressure can intensify, management execution can falter, regulatory environments can change, defense contracts can be delayed. That is why ongoing monitoring matters. Long-term investing does not mean blind investing. It means periodically reviewing fundamentals to ensure the original thesis remains intact. If revenue growth collapses structurally, if competitive advantage erodes, or if capital allocation becomes reckless, adjustments may be necessary. But assuming disciplined leadership and continued innovation, these companies have characteristics that align with multi-year secular trends. Let me bring this back to you as an investor. Retirement wealth is rarely built from chasing headlines. It is built from identifying structural winners early enough and holding through volatility. It requires patience during drawdowns and conviction during uncertainty. 𝗗𝗏𝗧's comment about the makings of a bottom is not about predicting every tick. It is about recognizing when fear may be overextended relative to fundamentals. If markets are indeed stabilizing, and if growth stocks have repriced meaningfully from prior highs, the next decade could present asymmetric upside for disciplined investors. MongoDB captures the data backbone of the digital economy. Atlassian captures the execution layer of modern organizations. 𝗗𝗟𝗏𝗏 captures the autonomous evolution of defense technology. Different sectors, different drivers, shared potential for long-term structural growth. If you believe in data expansion, digital collaboration, and defense modernization as multi-year trends, these companies sit directly in those paths. The real question is not whether they will fluctuate next month. The real question is whether you have the patience to let compounding work for you over 10 years. Because retirement-level wealth is rarely built in a straight line. It is built through disciplined allocation, intelligent diversification, and emotional control. That is the framework. In this video, we connected 𝗗𝗏𝗧's broader market perspective with 3 specific growth opportunities positioned for long-term expansion. Now it is up to you to do your own research, assess your own risk tolerance, and decide how these ideas fit into your strategy. If you found this breakdown valuable, make sure you stay focused on long-term fundamentals, not short-term noise. That mindset shift alone can change your financial future.